Hello, my name is Melissa Treviño, Administrative HR Assistant for HFTP. Welcome to today's webinar, Accounting Standards Update 2016 Leases, Changes to Lease Accounting. This webinar will review the changes made to the lease accounting by Accounting Standards Update 2016-02 Leases. Explore the new rules for both lessees and lessors, the various types of leases, how to account for these leases, the impact on the balance sheet, income statements and cash flow statements, the implementation requirements, and more. Our presenter today, Adian Kummet, is Manager of Assurance Services. Adian has practiced public accounting for more than 6 years and provides financial and compliance audit and consultation services to a variety of public and private sector entities. Welcome, Adian. At this time, I will turn the floor over to you.
Good morning, everybody. We hope this finds you well. Thank you for joining us. Alongside myself presenting today is Mike Beacom. He's a partner in our Dallas office and we'll flash some slides with the credentials. We're both based in Dallas and part of RSM's real estate and hospitality industry groups. Mike is the central region leader. So enough about us, and we will get on with the presentation. Objectives: by the end of this, we hope that you'll be able to understand the fundamentals of the new leases standard and identify how the new lease standard could impact your financial reporting and reported financial results. A bit of introduction and background on the standard for those of you. I'm sure that you've been aware of it for some time now, and as the effective dates approach, finally digging in and trying to figure out exactly how and when this is going to impact you. FASB introduced the new standard in February 2016 with a delayed effective date. This new standard will replace the current standard ASC 840 with ASC 842, so all references from here on out to 842 and 840 give you some context. The effective date of the transition for ASC 2016-02 is different, as it is for many of the standards for public and certain not-for-profits and employee benefit plans that file with the SEC will adopt first. And that date is for fiscal years beginning after December 15, 2018. All other entities will require December 15, 2019, and any interim periods for fiscal years beginning after December 15, 2020. Early adoption is permitted for all entities. The biggest thing that we've been stressing to our clients as a firm is not necessarily looking at specific adoption, but making sure that the infrastructure is in place to evaluate and then go through the process of accumulating the necessary data in order to determine and apply the new adoption, and to do that at the earliest possible time.
Yeah, I would say, this is Mike speaking. Our concern is that a lot of our clients haven't started the process of really doing an inventory of all the leases that are outstanding, and this is going to be potentially a time-consuming process. And so we encourage our clients, we encourage you as well, to start the process at least of starting to do an inventory of the leases, cross-referencing that to lease payments, just to make sure that you have a complete population of the leases, and so you know what you're dealing with on a go-forward basis.
Moving on, the genesis of this standard really is from the SEC's report on off-balance sheet activities as a response to the financial scandals that were present in 2001, 2002, namely with Enron and WorldCom. Sarbanes-Oxley Act was passed, and as a result of that act, Congress tasked the SEC with reviewing off-balance sheet commitments, which led to $1.25 trillion of off-balance sheet commitments being identified just for SEC registrants. on an undiscounted cash flow basis, and none of the private companies were taken into account. So as you can imagine, that number is quite substantial. The lessees, for the off-balance sheet commitments as far as what their operating leases are going forward, there's disclosures currently required, but really limited information regarding the nature of the operating leases, and really not much more than just the total obligation per year. The lessors, really the aim was the lack of transparency on residual values, not necessarily specifically identified in the report, but inconsistencies between how leasing guidance and revenue guidance interplay. An updated number, as those initial figures were from 2003 Bloomberg Tax dated March 1, 2016. Again, just reiterating that upon the adoption of this standard, the balance sheets of the following airlines, retailers, banks, hotels, retail chains, expected to balloon under the new lease accounting standard, just due to the fact that the recognition of those outstanding off-balance sheet previously obligations will be incorporated into the face financial statements. A couple of facts: approximately 85% of leases are not currently reported on balance sheets on a global scale. So again, a quite substantial percentage of those. And in the U.S. alone, public company operating leases carried off balance sheet amounts in excess of $1 trillion. So, potentially on an individual basis, depending on different types of leases, it could have a substantial impact. And the aim is to give additional transparency to investors, lenders, etc. An overview of the changes as prescribed currently in 842 are summarized below. We'll start with the lessees. By far the biggest changes will be for the lessees. They will be required to record lease liabilities and right of use assets for most leases. We'll get into the details as far as which types of leases are excluded from this, but as a whole, the majority of leases will be need to be evaluated for purposes of this adoption. Income statement expense presentation will depend on classification of the lease. Again, we'll cover in detail the differences between the two lease categories that will be implemented as a result of 2016-02. Finance or operating are the two main criteria. The ASU will require more frequent reevaluation of arrangements, depending on, again, criteria that we'll cover in more detail. And build-to-suit guidance will be changed significantly from the current U.S. GAAP. Changes for lessors will be much less in scale, although there will be some changes. However, better alignment with revenue recognition, that it will also be adopted in the coming years, is really to try to marry those two. Leverage lease classification eliminated prospectively. That's a summary of lessee and lessor changes. Considerations as it relates to the adoption, specifically for purposes of looking at new leases that are being currently negotiated or are to be entered into in the future, and any credit facilities as far as the different ratios, current ratio, debt covenants, other financial statement measurements. Again, urging, as you're able, to start discussions with lenders and other users to ensure that everybody is aware of and that any differences, potential issues are hashed out prospectively.
I think initially there was some thought that the standard is going to result in a grossing up of the balance sheet, and so if that's the case, is it really that big of a deal? Well, I think the big issue at play is the debt to equity ratio. So even though you're grossing up both your total assets and your total liabilities, the asset side of the equation is not going to factor into the debt to equity ratio, and so that's causing a little bit of concern with companies now, knowing that they have certain covenants that they might have to revisit with their creditors to make sure that they don't fall out of compliance. with the adoption of this new standard, and if that ratio is to be calculated on a GAAP basis.
Moving on to give a little additional context as far as the scope of the standard. It's applicable to most leases except for those listed below: intangible assets, exploration and use of oil, natural gas. Short-term lease selection for those leases that are less than 12 months in duration and that do not include a option to purchase. There's certain transition methods that we will, and potential elections that will be discussed further, but as demonstrated on this slide, the majority of leases, I think especially in this industry, will be subject to the review and application of the new standard.
As it relates to the short-term leases, those leases less than 12 months, consideration will also need to be given if there's some options, renewal options on those leases, and what's the likelihood of those options being renewed. Once again, not to really circumvent the standard, if one were to have initial lease terms of 12 months or less and then all these renewal options, they're going to have to be factored into as well when you assess and determine whether you need to follow the standard for that lease.
Clarity as to what constitutes a lease, as defined, contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment, an identified asset for a period of time in exchange for consideration. This definition emphasizes the right to control use and identified property. Those are the key terms within this definition to determine whether or not you have what constitutes a lease. Additional color on the identified assets and control, the main crux of this definition. Does the contract specify an asset, either explicitly or implicitly, physically distinct portions of the assets, for instance, a specific part of a building or capacity portion? So is there percentage of the asset that will be used by one specific customer? Supplier does not have a substantive right of substitution. Examples of this are warranty and or upgrades. The other factor, control, customer has the right to obtain substantially all of the economic benefits from using the asset. Now on that, the substantially is the key part, which is broadly defined as generally 90% or more. And does the customer have the right to direct the use of that asset? There's a few different scenarios that we'll cover as we move forward to make sure that we're clear on what the directing the use of the asset entails. Potential contracts and leases that should be considered for purposes of determining whether or not it is a lease. Ground lease, computer and network equipment, vehicle shuttle buses, kitchen equipment, maintenance equipment, office equipment, copiers, arrangements where the hotel and or resort is the lessor, specifically restaurant space, retail space, spa operations. Identified assets. Is there an identified asset? Assets can be identified either explicitly in the contract or implicitly. An example of that is when the lessor has limited assets that can be used to satisfy the lessee's needs. Physically distinct, again, looking at a specific asset on a floor of a building, or there are capacity portions. Again, the determination of whether or not substantive capacity, generally speaking, 90% is the rule there. Does the supplier have a substantive substitution right? To determine this, supplier must have practical ability to substitute throughout the period of use and must benefit economically from substitution. So essentially needs to be able to have their benefit exceed the cost of substituting that specific asset. If the contracts permit substitution only when the underlying asset is not operating properly, in essence a warranty, or when an upgrade becomes available, that does not create a substantive substitution right for purposes of determining whether or not it's an identified asset. Highlight the change from current GAAP under ASC 840. Substitution right must economically benefit the supplier. Again, the benefit must exceed the cost. Entities will need to consider this criterion. It was not previously included in the guidance. If you cannot determine that the substitution right is substantive, you assume that it is not. So there is a if you're not able to demonstrate that it is substantive, you must go through and assume that it is not for purposes. Valuation of substantive performed at the inception of the lease. Shifting gears to the control of the asset, does the customer have the right to obtain substantially all of the economic benefits identified? A lease might not grant unlimited, unrestricted use, but might still be a lease. Again, percentages that we've seen generally as a rule of thumb is 90%, although I think additional considerations, if close to that percentage, can be factored in. And then the customer's right to direct the use of the asset. Direct is determined as how and for what purpose. Typically, this will be predetermined in a lot of instances, and that does not preclude that from being directed at the use of the lessee. If they have the ability to operate the specific asset on their own without interference, that can still be considered to have control. Customer designed the asset in a way that predetermines how and for what purposes. Again, having that included does not preclude, and most of the time will result in the customer having control. Change from current GAAP. Under current GAAP, a lease may exist solely based on the right to obtain substantially all of the economic benefits, and with the ASC 842 implementation, requires that the customer have decision-making rights, and some contracts that were previously considered leases will no longer meet the definition of a lease.
Separate lease components, identifying components. Why is this relevant and important? Once a lease component is identified, the consideration associated with that component or cash payments made on that component will have a direct impact on the amount of the right of use asset or right to use asset and the lease liability. And so one's going to need to be mindful of what they classify under these component definitions, which we'll discuss here shortly through this presentation. Under the new lease guidance, lessees will need to determine whether a contract that contains a lease includes one or more lease components that should be accounted for separately. In addition, with respect to contracts that include both lease and non-lease components, for example, maintenance services, lessees may choose by class of underlying asset to either, one, not separate lease components from non-lease components, in which case each separate lease component and the non-lease components related to it are accounted for together as one single lease component, or two, separate the lease components from the non-lease components by allocating the contract consideration to the components based on their relative standard prices. Under the latter approach, the consideration allocated to non-lease components is not accounted for under the new lease guidance, and as such is not considered when measuring the lease liability and right of use asset. And so some folks might opt or take the practical expedient and try to go ahead and combine the lease component with the non-lease component for ease of use. And in doing so, that could have an impact of increasing your lease liability and the right to use assets. So one needs to be careful when they go ahead and do this evaluation. So on this slide here, you're going to see lease and non-lease components. ASC 842 requires identification of lease components, as I previously mentioned. If a lessee has the right to use multiple assets, the right to use each asset is considered a separate lease component that has to be identified. And we'll discuss the separation criteria a little later. So start by identifying separate lease components, then identify non-lease components associated with that. So your first step is to separate lease components from one another and then separate related non-lease components. Additionally, there are going to be elements in a contract or lease that do not transfer a good or service to the lessee. These are not considered components. And a little bit later we'll discuss what the definition is. So summarizing this slide, we really need to break out and identify for each contract what constitutes a lease component and what constitutes a non-lease component. On the next slide, you're going to see the definition of non-lease components include utilities, common area, maintenance on leased asset, examples of non-components, delivery of a leased asset, reimbursement of insurance or property taxes. The key here is non-lease components are components that provide a good or service separate from the lease. For example, utilities in forms of a maintenance represent goods or services separate from the right to use the property. In contrast, payment of insurance or taxes on a leased asset does not transfer a good or service separate from the lease. The payment of taxes and insurance is somewhat required to use that asset versus the providing of maintenance is not required to use the asset, but it is another service that is being provided under the contract or landlord, and so is considered a non-component of the contract that needs to be evaluated. A right to use an underlying asset is a separate lease component if both of the criteria are met. If one or both are not met, the right to use multiple assets is a single lease component. These criteria are based on the criteria ASC 606. And so a right to use an underlying asset is a separate lease component if the lessee can benefit from the right of use on its own or together with other resources readily available. Or two, the lease is not highly dependent on nor highly interrelated with other leases in the contract. So if you have an asset that's highly integrated or interrelated with other assets, you could potentially have to combine those leases instead of treating them as a single lease component. For leases that include a land element, the right to use land is a separate lease component unless the effect of separate accounting is insignificant. For instance, the separation would have no effect on the lease classification, or the amount that would be recognized for land component is insignificant. As I previously mentioned, unless the practical expedient is elected, whereby you combine your components together, lessees are required to determine the relative standalone selling price of the separate lease components and the non-lease components on the basis of their standalone selling prices. If standalone selling prices are not readily available, the lessee shall estimate the standalone selling price, maximizing the use of observable information. Then the lessee must allocate the contract consideration to the separate lease components and the non-lease components on a relative standalone selling price basis. So once again, if whatever is being allocated to the lease component will directly factor in to the amount that's being recorded on the right to use asset and the corresponding liability. And so it's critical that you determine how you want to combine the two, or if you want to keep them separate, and assigning values to those components. Polling question. Lessor and lessee enter into a 5-year lease for space within a building. Lessee will pay $13,000 per year, which includes rental, real estate taxes, insurance, and common area maintenance. How many components are in this arrangement or contract? I'll give a few seconds or minutes here and let people have a chance to respond. Anticipation is killing me here. The answer is C. There's two components. The components are the lease component and two, the common area maintenance. Common area maintenance, again, is a non-lease component because the lessor's activities will transfer a service to the lessee, the maintenance of the property. Insurance and taxes are commonly not considered non-components. With regards to components, the change from current GAAP, which pretty soon will be past GAAP or historical GAAP, but change from current GAAP as compared to 842, current GAAP equipment is required to be separated from real estate. Both parties generally tend to account for leases of multiple underlying assets on a combined basis if the assets are interdependent. Under 842, separate lease components are required if a lessee can benefit from the right of use on its own and the assets are not highly dependent on one another. Again, under 842, lease and non-lease components need to be separated, unless the expedient is elected, as we previously discussed. Under current GAAP, land and building elements must be separated when the fair value of land is 25% or more of the total fair value of the lease at inception. Allocation, lease payments equal to fair value of land multiplied by the incremental borrowing rate allocated to the land element. Under 842, going back to this whole standalone selling price, allocations will have to be based on standalone selling prices using the best observable inputs that one can find. Moving on to concepts and definitions. Commencement date. The commencement date is the date on which the lessor makes the underlying asset available to the lessee. As we will discuss on the next slides, this is an important date because 842 changes the recognition, measurement, and classification date to the commencement date, unlike past guidance, which I think was on the date of inception. So change from current GAAP to the new GAAP, commencement date related. Current GAAP. Initial measurement occurs at the inception. Classification assessed at inception. Recognition at commencement. So even though that's current GAAP, that's kind of the way it was historically done in the past. Going forward, under 842, the initial measurement occurs at commencement. The classification is assessed at commencement, and recognition is at commencement and not at inception like it was under the old GAAP. Misstatement of lease assets and lease liabilities could happen if we do not get this date right. Improper measurement could occur if some of the key inputs used to measure liability and asset change over time. And so identifying the wrong date might lead to use of incorrect information, leading to an inaccurate measurement. So once again, we need to focus on the commencement date going forward. What is the lease term? The next slide will show the lease term is really comprised of various component segments. You have a non-cancelable period, an option to renewal if lessee is reasonably certain to exercise that option. Periods covered by options to extend, not to terminate, which are exercisable by the lessor. Periods after termination option if lessee is reasonably certain not to exercise. The term reasonably certain is to be interpreted as a relatively high standard or threshold and is generally interpreted similar to the meaning that it has in ASC 840, which is reasonably assured. When you are assessing whether renewal is reasonably certain, i.e. reasonably assured, consideration should be given to how important is the lease asset to the lessee's operations. Has the lessee installed significant leasehold improvements or customized it in some other way? Has the lessee sublet the property beyond the end of the non-cancelable term? So the more that the lessee has invested in this lease, the more certain that the lease term options will probably be exercised. The longer the period from commitments to exercise date of an option, the more difficult it will be determined whether exercise is reasonably certain. For evergreen leases or month-to-month leases, as we briefly mentioned a while back, or other leases with no stated term, consideration will need to be given to short non-cancelable periods, but you need to consider whether the lessee will continue to use the asset. So again, if you have a situation where you have a month-to-month lease with these renewal options, if it's highly certain or reasonably certain that, or reasonably assured that the lessee is going to continue using the asset, you'll need to factor that in when you're defining the lease term. And once again, it'll probably take you out of the short-term lease classification into 842. 842 does require lessees to monitor leases for significant changes within the control of the lessee that could change the lease term or the likelihood of an option being exercised. Examples of events or changes within the control of the lessee include construction of significant leasehold improvements that are expected to have significant value, making significant customizations or modifications to the underlying asset, making a decision that is directly relevant to the lessee's ability to exercise an option, subleasing a period beyond the exercise date of the option. So if these things happen throughout the use of the asset, consideration will need to be given as to how that impacts the lease term being used to measure the underlying right to use of the asset and the liability. In addition to the commencement date, the lease term, consideration needs to be given to lease payments. Lease payments are considered fixed payments, including in-substance payments, purchase options if exercise is reasonably certain, termination options if the exercise is reasonably certain, residual value guarantees if probable of being owed, and variable lease payments that depend on an index or rate. Fixed payments are those required by the contract, and in-substance fixed payments are those that are described as variable or appear to contain variability, but the contract terms require the payment of some unavoidable amount. An example being a lease that requires a lessee to pay 1% of its sales subject to a minimum sales figure to be used. You're going to have a minimum lease payment that has to be made, and so you have a fixed payment that needs to be taken into consideration. Variable payments are included in lease payments, but only those that are tied to an index or rate. So we'll discuss that in a little bit more detail, but a common example of that would be a CPI lease that's referenced to a CPI index. Is there a purchase option that the lease is reasonably certain to exercise? If so, that needs to be included in the lease payments. Variable lease payments. Lease payments, once again, only include variable lease payments that depend on an index or rate, derived using a rate or index at commencement, remeasure only when lease payments are remeasured for another reason. And so if you had a situation where you have a lease that's tied into has a CPI factor, whatever that rate or factor is at the commencement of the lease, that's what you would go ahead and determine what your variable lease payments are to go ahead and somewhat convert that to a fixed lease payment and include that into your lease payments that are going to be used to determine the amount of the right of use asset and lease liability. Excluding variable payments from lease payments will result in a smaller liability, an ROU asset, more likely to result in operating lease classification, and more likely to result in a straight line accounting. Change from current GAAP as it relates to residual value guarantees. Under the current GAAP, minimum lease payments include full amount of the residual value guarantees if the amount likely to be owed. Under 842, lease payments include amount likely to be owed, likely to reduce liability, and ROU asset for finance leases. Polling question number 2. Lessee and lessor enter into a lease. Lessor incurs the following costs: $30,000 in allocated costs of salaries, $35,000 external legal fees, negotiating and drafting a lease, $40,000 of commissions payable. Which of the above qualify as initial direct costs? This is another difference between the old GAAP and the new GAAP under 842. For purposes of time, I'll go ahead and answer. The only expenditure listed under 1, 2, and 3 that will qualify as initial direct costs is E, commissions. The commissions qualifies because they would not have been incurred if the lease had not been obtained. Employee salaries would have been paid whether the lease was obtained or not. Similar, the external legal fees would have been incurred even if the lease had not been executed. So to highlight the importance of initial direct costs are defined as those incremental costs of a lease that would not have been incurred if the lease had not been obtained. This is a different than the definition in current GAAP. It represents a significant narrowing of costs that will qualify for deferral. Discount rate, one last component that we need to probably address as it relates to lease terms, what have you. The lease liability is calculated by applying a discount rate to the unpaid lease payments, which we've discussed earlier what would all constitute a lease payment, ASC 842 requires that the lessee use the rate implicit in the lease unless the rate cannot be readily determined, in which case the lessee would use its incremental borrowing rate. The implicit rate is a rate that causes the aggregate present value of the lease payments and the amount the lessor expects to derive from the underlying asset in the lease term to equal the sum of the fair value of the underlying asset and any deferred initial direct cost of the lessor. We won't be going over that definition again. But so, discount rate, just be mindful. You should use the rate implicit in the lease. If it can't be determined, use the incremental borrowing rate. There is a practical expedient that where you can use, I believe, a risk-free rate for all your leases, but that would result in a greater liability balance. So you do not necessarily just want to default to that exception.
Okay, moving on to the details of lessee side accounting. So with the adoption of ASC 842, you'll see similar fact patterns that are currently in place to determine whether or not operating versus capital. The significant changes with 842 versus the current GAAP, similar to current criteria, however, without the bright line, so yet again, more gray area for us to navigate. Go through the list, 5 criteria, keying in on the fact that if any single one of these is a yes, the lease will be classified as a finance lease under 842, and if none of the criteria below are met, it is classified as an operating lease. Number 1, does the lease transfer ownership to the lessee by the end of the lease term? No specific bargain purchase here. Moving on to number 2, does the lease contain a purchase option that the lessee is reasonably certain to exercise? So you'll notice that this criteria has replaced the explicit percentage with reasonably certain. Generally speaking, we're looking at the 75 and 90% for the major part in number 3, 75% of the remaining economic life of the asset. Is the sum of the present value of the lease payments and any residual value guaranteed by the lessee equal to or greater than substantially all of the fair value of the asset? Again, generally speaking, 90% is used in this. And number 5, is the underlying asset of a specific nature such that it would have no alternative use to the lessor? So again, if any of these 5 criteria are met, classify as a finance lease under 842. If not, operating. Polling question number 3. Lessor and lessee enter into a 3-year contract under which a specific piece of equipment will be customized for lessee's use. After 3 years, lessor would have to incur significant costs to repurpose the equipment to be able to see or lease. There are no transfers of ownership and no renewal purchase options. Present value of the lease payments does not represent substantially all of the fair value. Remaining economic life of equipment is 7 years. How should lessee classify the lease under 842? So the correct answer is B. Lessee should classify the lease as a finance lease. The fact that the equipment has no alternative use to lessor results in finance lease classification regardless of other terms and conditions of the lease. So again, if any of those 5 criteria on the previous slide are met, finance is your answer. Initial recognition and measurement of both finance and operating leases. As mentioned previously, the biggest change introduced by ASC 842 is the requirement for lessees to recognize liabilities and assets for almost all leases. The recognition of this right of use asset and lease liability will be recorded at the commencement of the lease. The liability is measured by determining the present value of any unpaid lease payments with any measurement for both operating and finance leases. The initial right of use asset will begin with the balance of the liability and be adjusted for any initial direct cost capitalized by the lessee, which will be an add, any payments made before commencement, which will also be an add, and lease incentives received as a subtraction to get to your right of use asset. Subsequent measurements specific to finance leases. After a lease commencement, the lease liability on a finance lease is measured on an amortized cost basis. The liability is increased for any interest and decreased to reflect any payments made in the period. You will use the discount rate determined at commencement unless it has been reassessed. Periodic payments are allocated between a reduction of the lease liability and interest expense to produce a constant periodic interest rate on the remaining balance of the liability. For right-of-use assets, a lessee amortizes the asset, presumably on a straight-line basis, over the shorter of the lease term or the useful life of the right-of-use asset. Different term may be used if the lessee is reasonably certain to exercise a purchase option or if the underlying asset is transferred to the lessee. In that case, you'd amortize to the end of the useful life of the underlying asset. As far as the income statement treatment of a finance lease under ASC 842, the right-of-use asset is amortized as discussed above. Interest on the liability is recorded as interest expense. Variable lease payments that were not included in the finance lease liability initially are recorded as rent expense. For example, for any variable lease payments that depend on achieving a target, a lessee recognizes the cost in periods before achievement if achievement of the target is considered probable. Recognized costs are subject to reversal if it becomes probable that the target will not be met. Essentially, the lessee recognizes any variable lease payment that was not included in the lease liability calculation. Any impairment losses on the right-of-use asset, as may be required by ASC 360, are also recognized. Contrast of changes for both finance and capital leases under current GAAP. There's currently no reassessment criteria, and as discussed, ASC 842 must reassess for significant events that change the lease term or other items, and remeasure the lease liability and right-of-use asset upon reassessment and modifications. Subsequent measurement for operating leases. For operating leases, the lease liability is measured at the present value of any unpaid lease payments, calculated using the discount rate determined at lease commencement unless the discount rate has been updated as part of a remeasurement event. Note that the description of the subsequent accounting for the lease liability differs from the description under finance leases, but the exception is that the balance will be the same. The difference is the expense recognition. For right-of-use assets that have not been impaired, the asset is measured at the carrying amount of the lease liability and adjusted by any unamortized initial direct costs, as well as prepaid or accrued of prepaid lease payments. The last adjustment is a reduction of the unamortized balance of lease incentives received. On the income statement, a lessee will recognize a single lease cost comprising the amortization of the right-of-use asset and the interest. Under the prescribed method, the cost of the lease is allocated over the remaining lease term on a straight-line basis. The lessee would also recognize any variable payment for which the obligation is incurred, as well as any variable payments based on a target level if the target became probable in the period in question. The lessee would also recognize any impairment loss on the right-of-use asset that as may be required under ASC 360. Lease reassessments. You reassess whenever there is a modification to the lease that is not accounted for as a separate contract. A lease modification is a change to the terms and/or conditions of a contract that changes the consideration for a lease or changes the scope of the lease. Modifications will be discussed in more detail later. 5 situations that can lead to remeasurement, triggering events, change in lease term, assessment of likelihood of a lessee exercising a purchase option, examples of fact and circumstance changes, change in the amount probable of being owed under RBG, and variable lease payments become lease payments after contingency is resolved. Continuation of the assessments. In remeasuring, the following are updated: lease payments, contract consideration, allocation of consideration, discount rate, lease classification. A lease modification is not treated as a new contract. It's just updated throughout the calculation. Change in lease term, option exercise, update all. And a change in amount probable under residual value guarantee or resolution of a contingency for variable lease payments do not update discount rate or classification. This next slide will show a summary of the changes that will be made upon a reassessment for the different types. Moving on to the lessor.
When we initially started this presentation, we mentioned that the 842 really impacts the lessee side of the house and not as much on the lessor side. So with that being said, I'll just hit the lessor impacts on a very high level, and then we'll get back to the lessee impacts of the standard. As it relates to the lessor, the first step you're going to do on a lease, a contract that's been defined as a lease, you need to go back to the lessee classification of whether the lessee should record that lease as a finance lease. And those are the 5 criteria that Aiden went over briefly a few minutes ago. If any one of the 5 lease classification tests is met, the lessor classifies the lease as a sales type lease. If none of those are met, if none of the 5 are met, the lessor would go ahead and classify the lease as a direct financing lease if the present value of the sum of the lease payments and any residual value guarantees equal or exceeds substantially all of the fair value of the underlying asset. And I think by definition, that's 90% kind of a line of that's being used to make that measurement. If it's probable that the lessor will collect the lease payments plus any amount necessary to satisfy the residual value guarantee. If both of those are met, once again, and the lease doesn't meet the definition of a finance lease or a sales type lease, they will go ahead and treat it as a direct financing lease. If the 2 additional criterion that the lessor must evaluate, if one or both of these are not met, then the lessor would go ahead and classify the lease as an operating lease. So you're first going to look to see if the lessee classified it as a finance lease, then you're probably going to be the lessor is probably going to treat it as a sell type lease. If the lessee is not treating it as a finance lease, then you need to go ahead and see if the lessor should be treating it as a direct finance lease, and if that's not the case, then they'll treat it as an operating lease. There's another slide in the presentation summarizing some of the other changes to lessor accounting that we won't discuss at this point, but you can go ahead and look at those. Aiden also mentioned a few minutes ago about modifications. Believe it or not, the FASB was thinking that under 842, the guidance on modifications is hopefully simplified. A modification is any change to the terms and conditions of a contract that results in a change in the scope of or consideration for a lease. Examples could be any change that adds or terminates the right to use one or more of the underlying assets, or any change that extends or shortens the lease term. Modifications are accounted for as either a separate contract or as a change to the old lease. If the modification grants the lessee an additional right of use that was not included in the original lease, and the lease payments increase commensurate with the standalone price for the additional right of use, the modification is accounted for as a separate contract. If the modification is accounted for as a separate contract, you have 2 contracts to account for now. But if it's not accounted for as a separate contract, the lease liability is remeasured as of the modification date, as if the modification were a new lease commencing on that date. The steps to follow would be remeasure and reallocate the contract consideration to remaining lease and non-lease components, as we discussed earlier. Remeasure the lease liability reflecting the revised lease payments using the discount rate at the modification date. For modifications that decrease the lessee's right of use, reduce the carrying amount of the right of use asset on a proportionate basis to the full termination of the existing lease. Any difference between the reduction in the lease liability and the reduction in the right of use asset is recognized as a gain or loss on the modification date. For modifications that increase the right of use asset is adjusted by the amount of the remeasurement in the lease liability. Any initial direct costs, lease incentives, or other payments in connection with the modification are accounted for in the same way as if the modification were a new lease. The lease classification is reassessed at the modification date, If the classification changes, the recognition pattern of the remaining lease cost is changed respectively. In addition to the basic accounting, the new standard will require some additional lease disclosures. The disclosure objective is really to provide users of the financial statements with sufficient information to assess the amount, timing, and uncertainty of cash flows arising from the leases. Lessee will be required to, on finance leases, disclose the amortization of RU assets, right of use assets, and the interest. On operating leases, disclose the lease costs, disclose the short-term lease costs, disclose variable lease costs, sublease income, any net gains or losses on sales, leaseback transactions, weighted average remaining lease terms, weighted average of discount rates, operating and finance, and maturity analysis. Some of this information may not be currently available in your current systems, and so you'll need to start gathering that information as well when you do your evaluation. The lessor disclosure changes we won't discuss at this time. That really gets us to the transition.
The transition approach is a modified retrospective approach. The entity must recognize and measure all leases other than those that apply to the short-term exception that exists at the beginning of the earliest comparative period presented using a modified retrospective approach. The full retrospective or prospective transition is not allowed under the ASC 842. The modified retrospective approach is somewhat of a compromise between providing all of the information that users would want and limiting costs to preparers. Keeping this discussion of the transition at a high level because of time constraints, and there are a number of additional transition requirements that are not covered here, but we encourage you to look to the FASB's publication of 842 for a full disclosure listing and transition approach. Additional ASC 842 includes a number of practical expedients. There's a group of 3 that, if adopted, must be adopted as a package. The decision to apply the package of expedients is separate from the decision to apply the hindsight expedient. That is, the entity has 4 choices. Apply neither the package nor the hindsight expedient, apply both the package and the hindsight expedient, apply the package but not the hindsight expedient, and apply the hindsight expedient but not the package. And that brings us to the end of our presentation, and open the floor for any questions that may be out there.
And we do realize that this is a very summarized presentation. There's a lot of guidance in the standard itself that we encourage you to read the standard, and a lot of the firms have guidance out on their websites discussing the new standard and implementation thereof. Obviously, with private companies, there's a kind of focus on 606 right now with the revenue recognition. So I think some of the resources are being kind of allocated in that arena, but as this gets closer, there's going to be more of an emphasis placed on this, and understandably so. I believe there is a question as to where can we find detailed examples of how to apply these new lease accounting rules. Once again, I would go to the standard itself. They do have guidance examples there. I would look at the internet for some of the national firms to see what guidance they have out there. There's a lot of materials being produced with regards to providing guidance in this area and relevant. From an implementation standpoint, as I previously mentioned, we're starting to see a lot more interest in the standard. A lot of people were focused on the revenue recognition, but once again, people are now starting to put more focus on this as well, understandably so, especially considering what it can do to the balance sheet. Yes, we'll work with the administrator here to see how to best provide a link to you all. We have guidance on 842, and not just to tout RSM. The other firms will have it on their websites as well. I believe there probably is commercially available software available. Our IT folks would definitely know. I do know that people were looking at their current lease software and programs to see if they can, if it's going to be, this information is going to be really available to capture, or if they're going to have to modify it. Again, I don't have a definitive answer outside of, yeah, I'm sure there is software that could be out there to assist. All right, I think that's our allotted time. We do thank you for this, for sharing your hour with us. We know that everyone's really busy and got a lot of things going on. This will continue to evolve. You're going to see, I think, probably even more guidance come out as people really start implementing the standard with the public companies taking the first pass at it. And we'll see what kind of impact it has on some of the financial statements, what have you. But we will also speak with the administrator to see about providing you that link to our website. But by all means, you know, feel free to look at the other firms as well, because there will be guidance out there. With that being said, thank you for your time.
Again, a big thank you to Aidan and Mike for their excellent presentation today. On behalf of HFTP, thank you all for attending today's event. This does conclude our presentation, and you may now disconnect.